Rates then on your screen this morning, and we've started off absolutely flat, just lurking around that 17,400 print for the Nifty, flat for the Nifty Bank as well, marginally higher for the advanced decline ratio. But again, these are just early days yet. Let's first see what Wipro is up to after the restructuring of the business into 4 global business lines, which is going to take place from April 1st. That stock starts off just marginally higher as we speak right now. I can see spots of green across the auto pack. You had a Bajaj Auto. It's springing back into action after that 5.5% cut yesterday, holding up 2.5% up in the green right now. Hero MotoCorp, Tata Motors, these are all stocks which are actually holding up in the green, as is M&M. Metals as well making a smart move. Tata Steel, I can see on my screens, holding up 0.5% as we speak. Big boy Bajaj Finance looking up. And let's see what Reliance, ITC, individual stocks like ICICI Bank, etc. are up to, while the Nifty Bank has started off absolutely flat for itself. BOB, that's going to be included in the MSCI India Standard Index from today. And remember, this was a big mover yesterday as well, 0.7% gain coming in for BOB. Z, wherein the NSE has withdrawn the earlier order. May F&O contracts are going to be available from today. Z has jumped up almost 5% as we speak right now. There's, of course, Indiabulls Real Estate as well, a couple of top-level rejigs happening there. There's also Mastech, which has announced a strategic partnership with software solutions provider. So these are a couple of stocks which are in focus this morning. Cipla, the US FDA observations have been released, and they've been, they failed to review the discrepancy. So that's going to be another stock to look out for. 2.25% lower for Cipla as we speak. And then there is Biocon as well, which is going to be excluded from the MSCI India Standard Index come today. So that's another stock which is a little bit under pressure as we speak right now. The big movers from yesterday, besides, of course, BOB, there was also Can Bank and Abbott India, which held out nearly about almost 2%. Can Bank continues its up move, 0.4%. Abbott in the red as we speak. What are the Adani group of names up to? It was another sharp day of fall for Adani Enterprises yesterday. Was down 9%, down another 3% today, and that seems to be pretty much the trend across the Adani group of names. Adani Power, Transmission, all down as we speak. But Kunal, absolutely flat for the index. Any individual trend that you may be picking up?
Nothing much on the indices. Again, same old story that we are absolutely flat on the index. We could be getting in some bit of short covering on the Bank Nifty, but the stocks which I would be bullish on from an opening perspective would be Indian Hotels. I think that's a stock which looks very attractive on the charts. Classic risk reward, for Indian Hotels over the last couple of days. So that's a stock which I would continue to accumulate even at current levels.
Rudra, any active trades that you're executing right now?
Yeah, for me, GNFC looks very, very strong. In fact, on a fundamental news day before, from levels of 525 non-stop, it just made a move towards 560. Yesterday, again, it has just given that correction or profit booking, and it has again come back to those strong levels of around 525, 530 zone. GNFC looks very strong for me. One can buy it and hold positionally, available in future. I am looking at targets of 600 on GNFC immediately. Keep a tight stop loss of 525, a great risk reward buy at current level.
In top trades this morning, flat at an index level. But we've got a big market voice lined up to walk us through his outlook as to where he sees equities, individual sectoral opportunities, as well as what the outlook is when it comes to valuations. Nikunj in conversation with Sunil Singhania of Abacus Asset Manager. Nikunj?
Welcome to a brand new show of Markets and More. And it gives me great pleasure now to bring on board Sunil Singhania. On Markets and More, we would be discussing, ideating and understanding from Sunil the way forward for Indian markets, the way forward for the economy, and why are markets stuck in this kind of a range. And for those who are losing patience because last 12 to 18 months markets have not given any returns, is it time to start focusing and thinking of alternatives? Well, if you got equity long-term bull on TV, we all know the answer is that keep the faith and this shall also go. But why has there been a change in terms of the market participation and the level of interest? All that and much more on this edition of Markets and and More with Sunil Singhania. Sunil, fantastic to have you back on ET Now. Thank you for joining us.
Good morning, Nikunj. Pleasure being here.
There seems to be a change, and there seems to be a change in terms of approach, projections, outlook, and also participation for Indian equities in last 3 to 6 months. One side, all the concerns which were there in the world, they are getting addressed, yet there is no clear pattern at play. Why is that? And how long do you think this dull market will continue?
Hi. Actually, if you see Nikunj, I think the market made its near-term peak somewhere towards the end of 21. And though 22 started with a lot of concerns, particularly pertaining to the Russia and Ukraine issue, I think for the first 6 months we did not see too much of a impact of that, at least on Indian economy and demand. In fact, demand continued to be quite buoyant post the reopening of COVID. However, what you have seen over the last 2 quarters is companies facing headwinds, particularly in terms of margin. There have been massive swings in raw material prices, which shot up post the Russia-Ukraine issue and then came down sharply. The same thing was the case with energy and also logistics. At the same time, obviously, inflation in the Western world seems to be a little bit more sticky than what people made out to be. And on top of it, in India, we had an uncertainty about, one of the large groups facing some issues in terms of stock prices falling. So I think all in all, it has been, I would say, a nervous last 3-6 months, where overall, I think on the headline side, markets haven't been as bad, but broader markets have seen quite a decent correction. So it's been a nervous and a listless kind of a market, I would say.
So what do you think will be the out of jail card for the bulls?
So Nikunj, I think markets always have a reason to surprise. I mentioned to you about some of the headwinds. I think most of these headwinds are becoming tailwinds. So, for a lot of sectors, raw material prices have come back to normal. Energy costs are coming back to normal. And in fact, many sectors are benefiting from the sharp drop in logistics cost. Demand in India particularly continues to be quite buoyant. And though there is this small fear of El Nino, which might impact monsoons as we move forward, I think the winter crop has been very buoyant. We have had record production of agriculture as per the initial estimates. And prices are pretty decent, so farm income should be very good. The Indian, urban side also seems to present a fairly stable and a decent picture. We have a very, I would say, busy marriage season ahead of us. So I think all in all, the Indian economy seems to be in a much better situation. As far as the world is concerned, I think the world has been swinging, particularly on the back of what is the outlook as far as interest rate and inflation is concerned in US. So I think 15 days back, there was a risk on because yields fell from 3.9 to 3.4, and then suddenly last 15 days, the outlook on interest rates have again started to go on the reverse, and we have seen 10-year yields shoot up to 3.9. So we are in a yo-yo kind of a situation where risk off and risk on nowadays happens in like a month rather than 6 months or 12 months, which we used to see. But I would say that, after the initial sort of nervousness, we are heading into a space where, I would say good news can outpace the bad news.
For news to have impact on stock prices, the margin of safety has to be strong and relative valuations have to be attractive. So if the news changes and if the headwinds, they become tailwinds, do you think markets are now markets are now attractively positioned in terms of the valuation setup?
So two things have happened, Nikunj. One is obviously the markets have corrected. So I think over the last 15 months, markets have in fact been down on a headline basis by almost 8-9%. Broader markets are down, as I said, 20-30%. And we have added to the earnings. So the huge overvaluation which India had vis-a-vis the world is narrowed to some extent. The second thing, I mentioned, September and December quarters were not great for quite a bit, for quite a lot of sectors. Though on an overall basis, Indian corporates did pretty well in earnings, led by the financials in particular. But I think as we move forward, I think March earnings will normalize, and June can be a better quarter. And I think to that extent, if we just start to discount FY25, which would become the 1 year forward, suddenly Nifty would look like around 16 and a half times earnings, which is what the 10-year long-term average is. So I think from like 21, 22 times which we are looking at in the next 3-4 months, we should be start looking at Nifty earnings trading at Nifty markets trading at around 16 and a half times earnings, which is in line with the long-term trajectory. So I think that should be good. And on top of it, my view is that the world also should stabilize. The headwinds which the world faced in terms of high energy cost, particularly in Europe, which led to lowering of demand and a lot of again companies going out of production, is slowly coming back to semblance. There was this initial fear that the world might go into a recession. Now the IMF forecast itself clearly point out that there are hardly any countries which would have a recession. Most of the countries will grow, albeit a little slowly. And then you also have the Chinese economy opening up post the new year. After 3 years, you will have a normal Chinese economy, and that should pull the global growth back to a little bit of an upward trajectory. On an India perspective, I think obviously the foreign investors have been selling in India for the last 18 months again. They turned buyers towards the end of 22. However, some events have led them to be again small sellers. But as we move ahead and the indications which we get when we speak to our friends overseas and when we interact with prospective global investors, our view is that second half should see a good amount of inflow, which should more than offset the outflows which we have seen in the first 2 months. So I think overall a mix of global markets and economy stabilizing. I think Indian earnings coming back to normalcy for the broader sectors, and also flows turning positive. They all should basically aid, and the fact that valuations are now not as expensive should also lead to stability and an up move returning back to the Indian markets.
If I look at your last declared portfolio, the January portfolio, which is there in the public domain, there are 2 banks right up there, ICICI Bank and State Bank of India. Now, banks have done well, numbers from banks have been strong, NIMs have been decent. But is this the best what we will get from banks from a long time? Because deposits are low, credit offtake is strong, which means either margins will get compromised or growth has to be compromised.
So Nikhil, that is the beauty of the markets. I think January saw the best results from banks, but even then, year to date, banks have been one of the worst sectors in terms of movement. And largely a function of what you mentioned, people are expecting that this is the peak as far as earnings is concerned. And also, obviously there was some collateral damage expectation from what was happening in terms of one large group. However, having said that, if you see, what we are heading into, so the retail side of the credit demand is strong. And for a change, you also have now the capex cycle picking up, and you have corporate demand for credit also moving up. Yes, there will be some impact of the liability cost moving up because FD rates have moved up. But I think in India, on a percentage basis, the increase in interest rates has been much more narrower. So in US, from 1% to 4% is like 300% increase. In India, from 6.5% to 7.5% is like 15% increase. And I think to that extent, 50, 75 basis point passing on is not an issue. Credit costs have never been so good. And I think a function of all these make us believe that at least for the next 2-3 years, banks and financial services are poised for a good show as far as earnings is concerned. And stocks are not exorbitantly cheap. Obviously they are trading at higher multiple than what they were maybe a year or 2 back, but they are still trading at around book for a few banks and just around 1.5-2 times for quite a good number of good quality private banks. So we continue to be quite optimistic on this segment.
So what do you think should be the projected return from banks from here? Next 2 or 3 years, if one assumes that credit growth of 12 to 15% is here to stay, do you think banks will compound in that same with that same rate?
$1 million question, Nikunj, but just a disclaimer which I always give. I've always been an optimist on Indian markets, and I continue to remain so. And I think banks and financial services are an integral part of any growing economy. So, if our view of banks, the balance sheet growing at 12-13% would mean that profits can grow a higher 17-18%. And because they are I would not say they are, they are at a decent valuation, like they're not overvalued. I would say that returns should mimic at least the profit growth.
What is your projection for profit growth for next 2 to 3 years? Because for last 2 quarters, what we've seen is earnings downgrade, not an upgrade.
No, for banks, earnings have been upgraded. Yes, generally for the corporate India, as I mentioned earlier, there were headwinds for quite a few sectors in the September and December quarters, and we have seen some downgrades. But I think overall for corporate India, we still continue to be quite optimistic of a 15-16% earnings growth for the next 2 years. Obviously, 24 would be led by financial services, where the earning trajectory would be higher, but other sectors would catch up, over the next couple of quarters. And Nikunj, we also have to keep in mind that 24 is an election year, and historically we have seen that both consumption as well as capex on the government side picks up in the run-up to the election. So I think that should also be a tailwind as far as the growth in the economy and corporate profit is concerned. The other thing is, some sectors, some companies which had an exposure, particularly to Europe in terms of exports, have suffered last 6 months, and now Europe is slowly starting to get its feet back, and that also should start to become less of a headwind in the next couple of quarters.
From a market standpoint, do you think the sell-off in Adani group of stocks is something which is well digested?
So I would not like to comment on that, but see, I think at Abacus we have always followed the discipline of valuation, and it's not only this group but a lot of other stocks which have great quality but priced beyond perfection, which is what makes us a little bit of having a value conscious approach, and I think that is what we have continued to follow.
My question was that from a market standpoint, do you think the selling in Adani group of stocks and the domino effect, let's say, created on lenders and other banks, do you think that's behind us?
So, time heals and time makes us forget a lot of things. We are already, I think, 1 month into the process or the news flow. I think a lot of water has flowed below the bridge. I don't know whether this is the end of the news flow, but I would say that markets over a period of time, as has been the history and I would say experience earlier, tends to sort of make it less and less relevant as we move forward. So maybe it was very relevant towards the end of January. It is relevant maybe today, but not to the same extent it was January. But I think with time, markets will forget and move on.
When we spoke a couple of months ago, you did call out that private banks and small mid-tier banks were looking cheap, attractive, and they were growing and their balance sheets were in a fine fettle. Some of these banks have rallied even after the recent underperformance, on an average 30 to 40% in last 1 year. Do you think that now small and mid-tier banks are no longer cheap?
No, Nikunj, we, I think, make the mistake of just looking at very near-term performances, both on the upside and downside. So smaller banks have done well last 1 year, but for the previous 5 years, they've done nothing. And I would say that some of these banks have transformed themselves, in terms of adoption of technology, in terms of moving to better practices, in terms of lending as well as attracting customers. And some of them still look pretty reasonable given their faster growth trajectory. At the same time, I think in banks, one has to be now a little bit more choosy in terms of bank to bank. You can't classify the larger banks in one basket, the smaller banks in another basket, I think you'll have to pick and choose because the trajectory of asset quality and growth can be very different for different banks. And here I would say that banks who are a little bit forward-looking are the ones which should be preferred over banks which have been a little bit late in terms of technology adoption.
Sunil, a year ago, consumer tech and fintech stocks were trading in bubble zone. A month ago, they had come down to levels what could be called as a fear zone. How are things looking for the entire consumer tech and fintech? Because most of the promoters I have met and we've interacted with are of the view that the path to profitability cannot be compromised now.
So, I think first on the technology front, great entrepreneurs, great companies, hats off to them. They have created segments which did not exist, businesses which did not exist, given employment to so many people, make our life so easy, in terms of whatever we do on a day-to-day basis. Having said that, I think these investments are for investors who understand these businesses and are willing to take a 10-20 year call in terms of growing the business and profitability. As I said, we are value conscious investors and we don't invest in companies which don't have profits or don't have visible profits. And I think most of them still don't have visible profits. Obviously, there are a couple who are on the fringe of seeing profits. And I would say that as the markets get more and more comfortable on their road to profitability and self-sustenance, then more and more investors will look at it. Nikunj, what happens is a lot of these companies depend on regular capital infusion to just sustain. I think those companies are definitely at risk because if capital dries up, then their existence itself will be at risk. But companies which can sustain through at least internally generating what they need to grow, I think those companies have a better chance of surviving and maybe even thriving. As far as consumption companies are concerned, the whole concept of growth, growth means that you have to grow at a faster pace than the nominal GDP growth of the country. A lot of these consumption companies trading at 70-80 PE were growing in line with the nominal GDP or even less. And I think the markets have lost patience because of the last 2, 3, 4 years of them constantly, disappointing on growth. And to that extent, there has been some price correction and some time correction. I think going forward, there is a little bit of room, more left, maybe both time as well as price correction. And then, a lot of them have great franchises, great brands, and they will become really attractive.
So can I say that when the selling or when we saw a real selling stampede in some of the consumer tech and fintech stocks, as a fund house, you did not participate in them. You've not bought any of the new tech companies.
So, Nikunj, it's very easy to get swayed by price movement and say that this stock has fallen 50%, let us buy it, and this stock has fallen 75%, let us buy it. But as I said, we are looking at investing as if we are becoming partner in the businesses, and therefore our horizon is 3 to 4 years. So there are 3 basic rules which we follow. One, the company has to be profitable. Second is there has to be visible profit growth, maybe doubling of profit at least in 4 to 5 years. And the third is, what we pay today should be more than repaid to us by way of future profitability. I think most of them still don't fulfill these 3 criteria. And therefore, at least for us, just because a stock has fallen, do we buy it? I don't think that is what we follow.
So where do you see this combination working, where you are conscious of profitability, where you think that profit in 3 to 5 years should at least double, that's a threshold, and they should give you a decent entry point? Where do you think this combination is at play for you?
I think that's an ongoing exercise on a daily basis. Our battery of research analysts keep on digging it and meeting companies. But Nikunj, what has happened is, obviously there are companies who did very well. And then last 1 year, there has been, suppression in terms of earnings because of huge movement in commodity and input prices. But a lot of them have cleaned up their balance sheets quite substantially. and they have emerged very strong. So I think the next leg of winners would be companies who have used this bounty of profits which they have made over the last 2-3 years to make their balance sheets very light in terms of debt. So there are quite a few. I think metals look pretty decent, and particularly after the recent short-term correction, I think China opening up is for real, and there should be some demand coming in from metals. Chemicals was a very hyped sector, particularly specialty chemicals. I would still say that a lot of these companies are still pricey, but some of the non so-called specialty chemical companies are coming back on to good levels. Same is the case with pharma. I think underperformed big time, but a few pharma companies have started looking pretty decent. And the mid-cap IT pack, maybe, if you have a small correction further from here, they would start to look pretty exciting. Also, some of these building material companies have suffered because of massive input cost increases, and stock prices to that extent have corrected. I think that's a long-term trend, with more and more housing in India. Some of these building material companies also look pretty exciting.
Sunil, let me draw your attention to slowdown. Consumer companies are complaining there is a slowdown. IT companies are already starting feeling the heat. Layoffs have started in the startup world. Most of the middle of the pyramid or bottom of the pyramid categories are contracting. Do you think this is temporary in nature?
No, you are right. I think this whole talk about the K recovery has been for real, at least in the last 1-2 years. So, the upper end have been spending like crazy. We don't have rooms in hotels. The ARRs have moved up, flights are full, and so on and so forth. And as you rightly said, on the lower end, there has been a demand compression. But I think that should change for a couple of reasons. One is now we have a normal economy. So at the lower strata of the society, I think there are no further job losses. In fact, there is an improvement in job opportunities. Construction is picking up pace. It's a big employer, at the lower level. As I mentioned earlier, farm income should pick up quite nicely once this winter crop is harvested, because both the produce as well as prices are at record highs, and that should do well. And in the run-up to the election, normally, you have the economy picking up pace, and there is a multiplier effect which impacts the lower strata of the society much more. So I would be more constructive over the next 6-12 months that the slowdown in demand, particularly at the lower level, should start to equalize. Already when we speak to companies, I think steel, cement, we are seeing good demand. And that is an indication that the capex as well as the infrastructure side is picking up pace. Government's allocation for this year is at a record 10 lakh crore as far as infrastructure is concerned, and that again has a multiplier effect of at least 4-5x of what the government spends. So we would be constructive. I think things would start to fall in place.
All right, there you have it. Sunil Singhania sharing his outlook on the markets. Tell you what, we'll take a very quick break. Stay with us for more outlook on the markets, the GDP view, as well as we've got Dr. Naresh Trehan of Medanta lined up when we return.
Right here on 80 now, let's just revisit what the first trades have settled in at. While it's been an absolutely quiet start for the index, Z is springing up actually 4.25%. So is Bajaj Auto after that over 5% fall in trade yesterday. Today it's holding up 2.5%. In fact, a lot of these autos and auto ancillaries are the ones which are actually buoyant, to be honest. M&M also holding up by 2.25%. Motherson Sumi up 1.5%, and Apollo Tyres as well, which is up in excess of 1% as we speak. Still under pressure though for Adani names, for Biocon, Vedanta, Hindalco. That segment of the market continues to weigh heavy. But what's also been looking up is the entire energy space. So let's try and understand that a little bit better. We have with us Sanjay Kumar, the MD at IGL. It's a good time as any to get in a sense of whether they actually see volumes growing up and what really is the way ahead for IGL. Sanjay, great to have you on ET Now. Thank you so much for taking the time out. You did a total volume of around 8.1 MMSCMD in the third quarter. How have been the volumes in the first 2 months of the fourth quarter?
So thanks for having me here, Aisha. And we have actually, we have increased our volume slightly over 8.1. That is the average that we had reported last quarter. Presently, we are clocking about 8.25 to 8.3 million cubic meter per day of volume. So the volume has been growing up. The reason being that the pricing has actually cooled down a bit. While we use more than 8 million cubic meter gas, about 75% of that gas comes from APM, non-APM pack. And the remaining is sourced from the market, whether it is our long-term contracts or the contracts from spot market or gas exchange. Now there the pricing has come down recently, and the pricing presently that we are looking at in these markets is about $14 approximately. So that's a big relief for the CGD companies like us, who used to pay pricing in the excess of $30 only 6 months ago.
Also wanted to understand if you could just give us a breakup as to what kind of growth you're penciling in from older as well as newer areas, if you could just classify.
Yeah, so majority of the volume presently that we are marketing is actually in the areas around Delhi. So the new GAs that we have in Uttar Pradesh, Rajasthan and Haryana, we are commissioning major pipelines there in next 3 months. By June, we will be commissioning major steel pipelines, which will provide actual gas supply to these geographical areas, and the CNG stations would have online gas supply. Presently, the CNG station in these areas are catered by LCVs, commercial vehicles having cascades. So which is not a very good model, not a very, optimum supply model for CNG stations. So once we commission these steel lines, we will see a lot of growth in new areas like Kanpur, Muzaffarnagar, then in Rajasthan, Ajmer, then Haryana. So we plan that we will have 1 million cubic meter growth from these areas in next financial year. That is by March 24 end. That is the estimates that we have at our end.
Mr. Kumar, morning. And the CNG price differential as well to diesel, that has nearly halved. Is there a slowdown in car conversion as well owing to the same? And what is the current conversion rate?
Depends on the operator of the geographical area. So for IGL, we have not increased our prices to that extent. We have maintained our prices at the approximate level of 79 rupees in Delhi for last 4-5 months. Now, if the prices are moderate, the conversion rates would continue. Our conversion rate in the month of January has actually increased. From 14,000, we have clocked 16,000 vehicle conversion in the month of January for our geographical areas, the 11 geographical areas that we have.
All right. And what part of your CNG volumes are sold to buses and how much to three-wheelers, and which are more likely to be converted to EV according to you or by regulatory intervention?
Yeah, so in 20% of our sale is to buses and to other autos, etc. Now, some part of that sale may be compromised because of EV buses. Buses are big CNG customer, and in order to manage this risk that we are facing, we are planning to get into a bigger way in EV also. And second thing is that we would, if we keep our price moderate, it will be slightly difficult for the decision makers to convert to EVs, because the cost factor is always there in the EVs. But that risk actually pertains to Delhi, which has the possibility of converting to EV, the buses converting to EV. The other areas that we are operating in, they may actually take more than 5 years to convert buses into EVs. That's our call.
5 years from now, what would be the core business of IGL? Will it be a gas company which also is using their outlets to give other additional services like EV charging, or you will remain a gas distribution company at heart?
We will be participating in EV business also. But Nikunj, the experts all around the world are talking about energy trilemma, which is affordability of energy, sustainability of energy, and energy security. Now, if energy security is not there, it will be a problem. Affordability is also very important. Now, if you look at the way things are panning out, most advanced countries would reduce their gas and oil consumption in coming 10-15 years by maybe 50% also. But countries like India, there the impact would not be so much. In fact, our gas consumption, the Indian gas consumption, is likely to peak in the year 2037 to 2040. So we would continue to grow from here to 2040. And if the gas consumption in the country continues to grow, IGL would continue to have, larger part of their business from the gas business, and EV will be the second business that I see in 5 years from now.
Be able to incubate the EV business because that involves setting up of infrastructure, it involves setting up of charging stations, so infrastructure has to be invested first and the annuity starts later. Can you do it on the existing balance sheet with the existing cash flows?
We are debt-free company, and we do not see any problem in that. Moreover, the EV business has come up with its own model. People are actually offering that annuity. They set up the charging facility, and they try and get some share of some percentage of revenue that comes from the charging business. That model is also very prevalent. We have come across that. For IGL, we are presently debt-free company. We don't foresee any such problems.
All right. We wish you all the best. Thank you so much for joining in and sharing with us an outlook on how things are shaping up. Just a quick glance at the equity markets, and as things stand, continue to look absolutely flat at an index level. Ditto when it comes to the broader markets. You're not seeing any sort of a decisive move, which is something that we've been flagging off from the get-go. IBREL, Vedanta, SpiceJet, Rail Vikas Nigam, along with Mahindra Logistics and VIP Industries are under pressure. Triveni Turbine, Z Entertainment, as well as Karur Vysya Bank, KPIT Tech, and Ashok Leyland are some of the stocks that are active in trade. But time to get you the big exclusive as promised. In our latest edition of CEO at Work, Zomato's Dipinder Goyal talks about their path to profitability, saying that they are confident of growing their profits 10x in the next 5 years and that they can become a $100 billion company by 2030.
When Zomato went public, it was like the talk of the town. It is still talk of the town. But very big fundamental change is that the stock went from 150 to 40. How did you react to it?
I actually didn't react to it. I think somebody told me, and I don't look at the stock price, by the way. So somebody told me that the stock price had gotten there, and somebody told me that the stock price had gotten there as well.
Who's this somebody?
Someone WhatsApps me, like some random person, right? And internally, we don't talk about the stock price at all. And my reaction was like, okay, this is not actually real. This doesn't make sense. And when it got to the bottom, I had the same reaction. This doesn't make sense. So I don't know what makes sense, but neither of these highs and lows
So what makes sense according to you?
I have no idea. Somewhere in the middle. Right? But I was always like, this doesn't make sense. This doesn't make sense. So it's okay.
But
Life will catch up.
since you were amongst one of the first consumer tech company, the new tech internet company, which used the word path to profitability. It was like saying that when you were in a private arena, the rules were different. Now in the public arena, the rules are different. Has the transition from the private market to the public market forced you to start thinking about cash flows, profitability?
I would say no, because I think for the first 5-7 years of our life, we were actually profitable. In 2018, we also hit a profit. So I think whenever we have burnt money, it's mainly because the market has forced us to do it, and competition has forced us to do it, right? So there was a point in time where the competition raised $1 billion, and we had about $100 million in the bank, right? We still had to fight that much money with a lot less cash. So we've been efficient overall, I think. I mean, and profitability is also, I mean, we try to get there as soon as possible. I don't like to burn cash.
So if the stock would have been at 200 right now, your path to profitability, your commitment to what you've shared with the market would have not changed.
Would have been the same, at least for the business that the core of the business that we are in, right? So Blinkit is something new, and I think of the entire business in terms of sum of parts, right? So I don't think of it as one large P&L. So Zomato would have made money; it would have been on the same path. Blinkit would have been on the same path, right? So maybe we would have done something else, like maybe a third bet, right? But I don't think that us taking a third bet or not taking a third bet has anything to do with the market, right? It is to do with whether we actually believe that some bet is worth taking or not.
Fair point. So let's look at the transition. The transition for Zomato from big cities to small cities. In your last quarterly numbers, you've said business is slowing down. Now Indians are eating more, we're dining out less, we're experimenting from chaat to sushis, which means we want to eat much more. Is this temporary inflation which has hit the growth of the business? Is that the reason why the business has hit a mature curve?
I don't think it has actually hit a mature curve. It was a temporary 2-3 month phase, I think, right? And we also said it in the last letter that we think that we're almost back in action in terms of growth. I think it was probably due to a lot of weddings, there was inflation as well, there was a lot of layoffs as well. So I think it's a bunch of things, just like sort of flattened us out for a bit. But yeah, but I think, I mean, this market should grow 10-20x over the next decade. So
Why do you think like that?
I mean, Indians, they still largely eat at home, right? So, and our like frequency here is about 3.5 times a month of ordering out or like going to a restaurant outside. And when you compare to countries like US, China, the frequency is like almost 7-8 times more. So, and the penetration, I mean, lot less people are part of the system right now. And in the US and China, everybody orders and everybody eats out. So the number of people and the frequency at which they eat out has yet to grow. And this 10-20x still actually sitting out there.
Let me try and address two things here. One, the identity of the business and the commitment of the promoters. What is your vision for Zomato in 5 years? Where do you think Zomato could be? What are the business where you think you will experiment? What are the business you think you will be able to scale up multifold? And what are the businesses where you're thinking right now, should you go or should you not go?
So I'm actually not that patient as a person. So whatever question you ask of me for 5 years out, I will want to get it done in the next 2.
Okay.
Right? So I think Zomato, the core business has to be much bigger than what it is right now, and Blinkit has to get to profit, and that also has to be much bigger than what it is right now. Hyperpure is doing so well. So just these 3 businesses, if they get to 10x in terms of scale and profit, I would be happy.
Do you think
that.
they can reach that?
I mean, that's why we're betting on them and chasing them down. But
what about penetration levels? What about the fact that, you know, in major cities, ghar ka khana is convenience. But when you go outside to small cities, bahar jaake khana is a celebration. You are now moving from large cities to small cities. And there's a big change in terms of culture, in terms of variety. Could that be an impediment in terms of your future growth?
So, not. I don't think so.
देखिए वो poster भी है. Is this really the end? ऐसा तो कुछ नहीं है.
ऐसा तो कुछ नहीं. I don't think so, because even the customers who are ordering frequently in the larger cities right now, they started off with a 4 times a year use case 5 years ago, right? So everybody starts off with, okay, I'll order a cake on a birthday, or the kids go first in class, so let's order lunch, or somebody in the home falls sick who can't cook, or the maid didn't show up. So these are the use cases with which customers get onto the platform. Then the next year, okay, there is a match going on between India and Pakistan. Let's also order food, right? Hey, movie night, let's just go out and eat. Like, so that's how the frequency goes up. So the first year, customers order 4 times a year. The next year, they order 10. The next year, they order 20. The next year, they order 40, 80. Like, that's how the frequency grows. And we've got a large chunk of customers right now, which are in their first year of the journey. And we're seeing the same signs. Like, I think they will, this huge customer base will also grow up double. And we're at the start of that point right now.
You've given a guidance that the business for the quarter gone by has slowed down, but you've also indicated to us that green shoots are now visible. Does that mean that the chart what you've given us in terms of reaching to profitability for your core business will be achieved early?
I don't know. I mean, we're trying.
You're the only one who knows.
I mean, even if I'm the only one who knows, I would not be the one who says that. But I mean, see, we are always trying our best all the time. Right? So, and maybe we'll get there. And we got to profit last month. I don't know whether this quarter will turn out to be profit or not. And so whenever we give any timelines, it's sort of always the worst case scenario for us, right? Okay. So, I don't want to miss any deadline or guidance that we've ever given.
So can I say the mantra for you at Zomato is that under-commit and over-deliver?
Absolutely.
Okay. And when you say that you are confident about growth and it could be a multi-year, multi-level growth, you're being conservative?
I think so.
Okay. My next question perhaps is about what should 10 years back, I'm going to take the clock back before I take it forward. 10, 15 years ago, if one invested in stocks like HUL, ITC, Nestle, you pretty much have been part of the great India consumption. So what is Zomato? A technology company, a brand, a consumer company, or perhaps a company which will continue to experiment, continue to deliver, and continue to add new formats?
I think we're actually all three of these things, right? Because technology helps us scale. Brand also keeps us top of mind, and it also makes sure that our marketing costs are low. And the consumer story sort of makes sure that we ride the wave of India's growth. So it's a combination of all three.
Historians have divided world in two parts, AC and AD and BC. So let me divide my next question in a similar manner. Dipinder Goyal before the company went public and after the company went public. What has changed for you?
I think I went through a phase of trying to discover whether there needs to be a new me.
Okay.
I figured that, and I went through a bad phase, like ups and downs, but eventually I recognized that I was fine the way I used to be, and I need to bring the same level of energy, commitment, and drive back in. I don't need to be reacting to what other people ask of me, right? So,
but Zomato, gets a lot of attention. It attracts a lot of extra attention, if I may use the word. How do you keep yourself calm when a mem reaches you, when a shareholder writes an email to you, when a retail investor says that 140 ka stock 50 rupees ho gaya? How do you keep yourself calm?
I think we're just like so used to it now. So, I mean, if we started losing our shit over any of these things, like we would not be able to hold it together.
Now let's talk about possibility. Like you said that you never expected that Zomato would become a 5,000 employee company and it in a sense will become listed. It was almost like a garage startup idea which got incubated on your work desk. Do you think there is a possibility that in 5, 6, 7, 8 years Zomato could be a $100 billion company?
I hope so, and I'm actually surprised why you're saying this, because internally that's what we actually aspire for. Internally that's the goal, that by 2030-ish we should be about 100-ish billion, right? And I mean, the way we see the business growing and changing in terms of scale and profit, I think we can easily be $1 billion plus in profit in 7-8 years time. But who knows, like his fingers crossed again. So.
Yeah. But for the entire architecture to work, you also need a team. And a lot of yes and no has actually happened with the recent exits. Founders are exiting. 4 key team members after public, they've gone different ways. Why is that?
I think, so first of all, there is nothing wrong with people leaving the organization anyway, right? So I think, I mean, people come here for 5 years, 10 years. We have about 175 people who have spent more than 8 years. So we don't have a attrition problem inside the organization. Now, see, different people leave for different things. Sometimes they have to spend more time with the kids, right? Sometimes they want to do different things. Sometimes they're done with active work life. They want to spend less time at work. Sometimes I would like raise the bar on someone and they fail to get there. So many things happen. Outside of the timing issue, like which was like 3-4 people in like 3-4 months, it's all normal here. And the timing issue, I think, happened because of the IPO, right? So IPO was a big thing and it changed a lot of people's lives. So a lot of people's personal lives changed, a lot of people's mindsets changed, ambitions, hunger, like so many things changed, like their form changed. And yeah, that was it. Like, and then suddenly we're like, okay, let's just like usher ourselves into the next phase and let the old make way for the new.
So we've discussed the 2 P's. Possibility and performance. Performance पे तो आएंगे अभी. अब last पे है paranoia. What are you paranoid about?
I am paranoid about failing, right? About our customers not liking us, about us not making money, about us not growing, about our partners not actually seeing the kind of effort that we like put in and seeing the benefit of the effort that we put in. I think just these things. I'm just paranoid about things not working the way they should in terms of quality as well as speed.
So 2 more questions. What are you doing to increase the reach and the moat of your company?
I think the quality of service that we have is one of the biggest moats, right? And we have very little orders which are actually delayed, right? So our customer earlier, like I think 4% of orders used to get a customer support call. It's 0.225 odd percent right now, right? So there are very few things which go wrong with the service right now. So it's basically the quality and consistency of the service which is the moat. And it takes years to build. It's not an overnight thing. It's little by little, like you just tune hundreds of thousands of things to get here.
So what is that one biggest constant customer complaint जो आपको मिलती है? आप कैसे solve करोगे उसको? You're in a food business, so you know customers will always have the viewpoint.
Customers, I think the quality of food or the taste of food is something which we can't solve, right? Because we don't actually control that aspect of life. But with a tighter ratings, the ratings that you see for restaurants, I mean, we are able to solve for most part. I mean, customers know that if they're ordering from a 2.5 rated place, they can't expect high quality food. But if they're ordering from a 4.5 rated place, then they can and like really expect high quality food. So rating system solves that, but we still get a lot of, hey, this food is not good, right? So, but we can't do much about that.
Literally not gone anywhere from where we started off. It's been flat throughout, really. While Adani Enterprises has made a sudden rebound, by the way. Let's just bring up that intraday graph up for you. Motherson, BHEL, Ashok Leyland, all these names are springing up in the green. But yeah, metals and select pharma, they are the ones which are under pressure. So good time as any to bring on board our chartists once again and try and analyze what trends they are spotting, what stocks are they recommending to trade. Kunal, your chart buster for the day.
Thank you, Aisha, for that. So yes, the Nifty is remaining to a range, and the range is just 72 points on the index so far, which is not even 0.5% for the index. But then coming to Tech Mahindra, again a very classic and interesting chart. So we discussed the broader parts of the charts for Tech Mahindra, that how the stock is forming a rectangular pattern and going towards a breakout. This is more of a short-term oriented charts for Tech Mahindra. And what is very interesting is the Fibonacci patterns over here. So the move actually started off for Tech Mahindra from this candlestick low, where the stock made a false breakdown, trying to go back into towards a breakdown mode over here below the 1,000 odd mark. But from there came a sudden recovery for the stock price. Now this move is what we call as the first wave of uptrend for Tech Mahindra. From here we look at for classical retracements. So the first leg of an up move generally gets halted at these two retracement points, which is 38.2 and 50% retracement for Tech Mahindra. Yesterday, the stock made a low which was just around that 1100 mark, which is the 38.2% retracement. If in case there is any further correction, the stock may come back over here, but this would become a classical entry point for Tech Mahindra. And even if you try and project the moves from here on, I would expect the stock to move towards at least 1250 to 1300 over the next 3 to 4 weeks. So this could be a very good entry point for Tech Mahindra. The current zone, which is around this 1120 odd mark to say 1080 levels, and if the stock happens to come back into this support territory, we could expect a risk reward which would be maybe 1:4 to 1:5 for Tech Mahindra. And given the kind of market scenario, those could be classical risk rewards for traders who are looking at a contra buy.
Right. And Kunal, what about the other stocks to trade?
So two buy calls which I would suggest over here. The first is on Biocon, again a contra trade. The stock forming a bullish divergence on the daily charts, targets of 245, stop loss at 220. And the second also is a buy call on Bata India, classical chart structure. The stock is forming a time-wise consolidation. Again, I think this 1400 to 1420 mark is a major bottom for Bata India. So would suggest a contra buy, 1480 as the target, stop loss at 1380.
Okay, let's move on and let's throw light on what the macroeconomic data is going to be focusing in on. And a cue to watch today, India's third quarter GDP print is going to be released, which is estimated to be around 4.5 to 4.6%. Harsh joins in to tell us what this number is penciling in. Harsh?
Well, yes, we're anticipating penciling in a 4.6% growth rate for Q3 FY23. That's what our poll indicates. SPI, which is the largest bank in the country, expects it around the 4.5% mark. Now we already know that the advance estimate for full year FY23 is roughly at 7%. And of course, now the second advanced estimate will also come out, but the RBI as well as the MOSPI have currently pegged that at 7% at the moment. So we'll work with that. Let's go backwards a bit. Let's look at the last few quarters where what has the GDP done. In Q1 of FY23, GDP growth was at around 13.5%, as you can see. In Q2, it was at 6.3%, slightly above. In Q1, it was slightly below our estimates. Q2, it was slightly above our estimates. And for the full year, the 7% advanced GDP estimate, which has come through, is versus at the start of the year, it was at 7.8%. So there's a 0.8% cut, and that's on the back of the fact that there is also the rate hikes which have started to come through. But before that, let's touch upon 5.4%, the Q3 FY22 number. That's the base we are looking at. Now let's look at the rate hikes, how they've progressed. There's been a 2.5% repo rate hike through the course of this financial year, and that's quite a large rate hike which will land up impacting growth. Just the question is, when will that start kicking in? The sense is it's already started, but the larger kick through might come in FY24. Let's look at some of the key indicators prior to that. We are seeing contact intensive sectors performing better. That's what's going to aid this year's Q3 GDP number. But there's a slowdown in exports as well as consumer demand on ground. That's what we're hearing from most economists. We're also expecting a moderation in the pent-up demand that has come through post-COVID. So a couple of those factors will play out in Q3. Of course, have to wait and watch on that final number.
Conversation forward with Upasana Chatra, Chief India Economist with Morgan Stanley. Upasana, good morning. Thank you for joining us. What should we expect to hear on India's GDP later in the evening?
Hi. So our number is also similar to the consensus estimates. We do expect GDP growth to be sub 5 at about 4.6% for the December quarter. But I think I'll point out that we should view this number in context of the high base, and also the sequentially the activity indicators and the GDP numbers are going to now normalize. So I don't think we should view this number as indicative of any major slowdown or moderation in the growth trend, but in context of normalization in the activity trends post the pent up that we saw in calendar 21, and therefore the base was therefore stronger, especially if you look at sequential activity numbers in that quarter.
Apart from the headline number, what about the fine print? In terms of the sectoral composition, the category composition, where do you expect a surprise?
So versus say the September quarter, we expect agriculture growth to be relatively steady and probably in similar terms in on a YOY basis. On the services side as well, we've seen from high frequency data that services indicators remain pretty okay in the December quarter. If you look at PMI services, air travel, hotel occupancy, other indicators which go in the financing, like the real credit growth, deposit growth numbers. So I think services will hold up. There could be some pockets where sequentially indicators have slowed. But overall services should hold up. On the manufacturing or the overall industry segment wise, I think manufacturing will probably continue to see some drag again basis the high frequency like the IIP numbers that we got in the December quarter. Um, and also the impact of the global slowdown and still elevated commodity prices, which have impacted profitability trends. But within the industrial segment, I think construction will be a bright spot basis the trend that we've seen in cement and steel consumption that we're seeing on the basis of the high frequency trend. So I think manufacturing will probably be a little bit downbeat, but probably but less of a drag versus September quarter, as we are seeing that corporate profitability trends, while declined by less in the December quarter versus what we saw in September. So I think there'll be a little moderation in the numbers on both services and manufacturing, but manufacturing may be a bit more of a drag on the overall trend.
Upasana, also I wanted to understand and get your sense in on what is it that you're seeing about the rural end of the economy, because that all and every indicator seems to be hinting towards in a suppressed state right now. Do you see any green shoots emerging, and do you think rural demand is going to come back anytime soon?
So, the rural demand or activity indicators that we track on a high frequency basis, yes, remain a little lackluster. But having said that, I think the worst is probably behind us. We track rural activity on a consolidated basis, all the high frequency data points like two-wheelers, tractor sales, fertilizers, agri credit, etc. that we get. And what our indicator is showing is that it's sort of steady. So the worst is definitely behind us. And I think if we look at some of the leading indicators like winter crop sowing trend, some of the improvement that we are seeing in incoming January data from say two-wheeler sales, and also I think the overall normalization in the labor market, by which I mean that the informal or the unorganized sector, which was impacted most severely by the pandemic-led disruptions, has now gone back to their usual forms of livelihood. That's evident if we look at the work demanded under NREGA, which is going down on a YOY basis. And I think that that normalization in the livelihoods or the labor market will have an impact on rural demand. There would be some lag, and therefore we have not really seen that in the numbers as yet. But I do think that we will see that in the numbers in the next few months, and we will see better rural demand indicators in the next probably 3 to 6 months than what we've seen in the past. So we are optimistic or constructive on the rural demand, and we do think that the worst is behind us on that front.
Hi, there's also concerns regarding the private capex cycle not exactly picking up. What exactly do you believe are still some of the stumbling blocks there, and when do you think we could see a meaningful recovery?
So on the private capex side, I think all the ingredients are in place for the capex cycle to kick in, be it in terms of what the government has done in terms of reforms or improvement in demand. So if you look at all narrative and commentary around growth trends, we are seeing that domestic demand is holding up. Domestic demand indicators are picking up pace. That's getting reflected in capacity utilization rates as well. And the balance sheet positions for both the corporates and the financial sector are the best in the last decade. So I think all the ingredients are in place. It's all about that now culminating, and we're seeing that in real numbers. I think on that front as well, if we look at some of the high frequency data points like new capex investments or announcements through the CMI database, that is showing a pickup. We are seeing that private projects under implementation or private sector new investments are now picking up pace, and I think we will continue to see that gain traction in fiscal 24, because as I mentioned, all the ingredients are in place, and the government is also pushing for capital expenditure on the infrastructure side, which I think will again help to crowd in private investment. So I think fiscal 24 is when we'll see probably a more meaningful traction to the private capex cycle.
Pasna, great to have you on the show. Thanks as always for joining in with that view on where the economy is headed and more importantly, what the GDP print today is going to entail. We're going to take a very quick break on that note with news that we're still pretty flat on the index. But yes, a lot of individual components and a lot of individual stocks are the ones which are moving this way and that. Z a top gainer, but Vedanta the top loser this morning. Quick break, be right back for more.
India is considered the fastest growing emerging economy across the world.
But Kavita, how can